All right, it looks like we have quite a few folks in the house today. Thrilled to have you all here. I'm going to change gears. Wonderful. Everybody, welcome to our investment strategy and returns webinar. Before we get started, I would love to introduce our speakers for the day. Again, my name is Korin Hedlund. For those of you I haven't met, I lead our investor relations team here at Arrived. We'll have Ryan Frazier, our CEO and one of 3 co-founders at Arrived, Cameron Wu, our VP of Investments, and Jake P., our Director of Operations. We have an action-packed agenda with all the things. First and foremost, investment strategy differences, risk and return of investment strategies, how leverage impacts investments. We'll move forward onto the returns matrix of investment strategies. We'll jump into our new and improved returns calculator, which Ryan Frazier will be demoing, as well as our coming soon properties that were recently released earlier this morning. So excited to jump through all these different components with you all. And then feel free to drop any questions that you have within the chat. I will either answer them in chat as well as our team, or we'll queue them up after prepared remarks. Excited to get started. Cameron, I'll welcome you up to the virtual stage.
Hey everyone, good to see you. Thanks for joining us today. So today I'm going to be talking about our 2 different investment strategies that we have on Arrived. It's single family residential and vacation rentals. So the goal of this is for you to really understand the differences between the 2 in terms of the asset types, the operating model, and the Arrived thesis for each one of those strategies. So let's start with SFR, single family residential, and we're talking about long-term rentals here. So residential assets, there's a lot of different types. You could have townhomes, condos, apartments. They're all considered residential assets where you live. And in our case, SFR, single family residential, it's a piece of land with no shared walls, right? It's your own property, and it's core housing. So you need food, water, air, and shelter. So when we talk about core housing, we're really talking about shelter and where you live. It is a mature and seasoned industry. There's been a lot of investment into the space for really as long as we can remember, and as long as it's been an asset class. But it's really been with mom and pop investors at first, but recently in the last 10 to 20 years, it has been institutionalized. So it is a mainstream Wall Street-esque large capital type class. So there's a great network of service providers and very competitive services. So all in all, it's great to have an industry that has a lot of competition in it. And that's where we are with single family residential long-term rentals. There is low operational complexity in the sense that it is a passive investment. A lot of times for certain tax treatments, you have to have what's called a passive operation. So there is lower operational complexity because you can imagine that you get a tenant in, and let's say that they really treat it as their own, no issues, no problems. There's fairly low operational complexity involved. Now, let's segue to vacation rentals. Now, these are also residential assets, as some of the channel names indicate, such as Airbnb. They are intended to be used from residential assets. And most of the time, we're talking about single family homes, at least within the context of where Arrived participates. So the use case, as opposed to core housing, is vacation, leisure, temporary. It's just travel, right? And compared to a seasoned industry, it's new, it's changing, it's growing. It hasn't yet been what we call institutionalized. There's not that big amount of capital going into it. Hasn't happened yet, possibly happening in the very near future, but there's a lot of opportunity when something is emerging. And in this case, there is higher operational complexity. Many of you have probably stayed in a vacation rental of some sort, or at least gone through hotels. So you can imagine the cleaning, the services. It's much more of a active operation compared to the passive nature of long-term rentals. So let's go into the asset types. Now, we mentioned that they're often both single family residential. In this case, they're all single family homes. So let's first talk about the SFR asset types. They tend to be suburban or multifamily because it really implies where is it located. So suburban tends to be second ring, third ring, outer satellite areas. Multifamily, we distinguish it this way because a lot of times multifamily, it can be in those same residential areas close to infrastructure and highways and things of that sort, but it can also be in the core of the city. So you'll notice that some of the markets that we haven't been in, such as some of the core coastal cities on both the West Coast and East Coast, they have affordability issues where it hasn't really fit our model type yet. But with multifamily, you can imagine that going to those coastal cities, there's just more opportunities to participate, and it is effectively the same, if not similar, business as uh, SFR with single family homes. So the asset types tend to be 2 to 5 bedrooms, 2 to 4 baths, 1,000 to 3,500 square feet, really core bread and butter housing. Our average portfolio ends up being somewhere around, just under 4 bedrooms, call it 3.8, and then just over between 2 to 2.5 bathrooms, right? So that at 2,000 square feet or so, that's core rental housing right there. So that's clean, safe, functional, cookie cutter. And those aren't always the nicest ways to describe properties, but it's a highly accurate of what you want in a rental asset that produces income. You want a lot of people to be able to look at that asset and say, hey, that looks reasonable. I like the location. There's nothing that is out there that I find distasteful. So we're going to go for a wide audience neutrality because we want high demand. And that's what generates good rents. And that's what help secure occupancy. So of course they have to be clean, safe, functional. It's kind of the gold standard of what you aspire for a rental home, kind of at a minimum. And then cookie cutter, again, not a charitable description, but highly accurate in terms of you want a market that is able to transact and sign leases and just keep that thing occupied. Now, where do we do it? Tend to be core markets. So top 40, top 50 MSAs, satellite areas of a top 20 MSA. So it's okay to own an hour outside of Atlanta. Atlanta is a top 10 MSA. So it is deployable anywhere because, as the name core housing would indicate, well, everybody needs to live somewhere. And we're going to expand, very strategically over time. But what's great about SFR is that it is scalable and it is deployable anywhere because people need somewhere to live. Now let's talk about vacation rentals really quick. Various residential, we do focus on single family homes, but a lot of things do work. You could use townhomes. You could have these multifamily units that work pretty well in various capacities. So a lot of different things work. Unique, more land, experiential. So kind of the opposite of single family residential, where we want a lot of asset and we don't want to pay for too much land, because the functional component of renting a home is, well, having the shelter, right? So if you're buying a huge piece of land, what we typically see are maintenance expenses and not necessarily value delivered to a tenant. On vacation rentals, on the other hand, you're looking for the ability to create unique experiences. Sometimes that can involve a sports court, a pickleball court, a bocce ball court, pools of some sort. So you do need land, right? And usually larger land comes with a larger house. And we're kind of getting into that profile where we're looking to have 5 or 6 bedrooms that can accommodate a larger group for something that, a hotel can't typically provide. If you're a 1-person, 2-person traveler, I think a hotel is a perfectly great solution. When you're traveling for a large group for various events, celebrations of some sorts, it's a nice niche to be in that we've identified. So it does tend to be in a bit smaller markets. So some of those names may be like Broken Bow, Oklahoma, for example. Really great vacation spot for if you live in Texas and kind of the Southeast, but it's not a place where you go to invest core housing at scale. On the other hand, that doesn't preclude it from being a larger market, such as Phoenix, Scottsdale. That's another top 10 MSA right there. And they've got a great vacation rental market where we have a couple of vacation rentals. Next, let's talk about the operating model. So SFR residential, this is core landlord tenant rental housing laws here. So the industry standard for how long a lease is 1 year. At Arrived, we structured a bit differently. We bias towards long-term tenants with 2-year lease instruments as our default. So most of our leases fall anywhere between 18 to 24 months, depending on seasonality. There's a lower initial investment, and a lot of that's driven by the fact that it's unfurnished housing, right? They're clean, safe, functional, and you buy the property, you buy the land, and there's usually somewhere between $8,000 to $15,000 of additional capital that you would put into it to harden it, make it more durable, and kind of ensure that clean, safe, functional standard at 5-star review to begin with, and scalable assets and ops. So there are institutional players, really great services at affordable costs out there. So scaling a game plan across the entire country does seem a lot more feasible with single family residential. And there's lower volatility of cash flows. It really has to do with the lease instrument and the fact that it is core housing, right? You have a lease instrument that entitles you to monthly payments in exchange for the service of a habitable residence. So in that sense, it has a lower volatility. Doesn't mean that the market doesn't exhibit some seasonality of demand. So for example, if you're trying to rent a property or lease a property out between Thanksgiving to Christmas time, it's a little bit difficult versus at the end of May, school gets out, households are making their moves across the country. That's a hot time to be in the rental market for leasing. Let's compare that to vacation rentals now. So you have rental agreements. That's the primary difference. We're not talking about landlord-tenant law. There's no lease instrument. We're talking about a rental agreement. It's much more commercial in nature, just like you sign in at the front desk when you go check in at a hotel. There's a higher initial investment, and primarily that's going to be coming from, one, the fact that we're buying larger assets, $700,000 and up typically, and there's also furnishing expenses. So we call it FF&E, fixtures, furnishings, and equipment. So that has everything to do with providing a great guest experience: forks, knives, bed sheets, pillows, beds, arcade games, amenities. All sorts of those things require an initial investment. It's less scalable because every property, it's more of its own personality, it has its own experience, and as such, to get those 5 stars and retain that over the life of the investment, you have to really pay attention to a lot of detail. And also, there's nothing that memorializes the agreement to pay for 2 years. So the pricing is a lot more dynamic, and you just have to keep your eyes on the market. So it is less scalable because there's a lot more moving parts, but again, there's opportunity in that. And higher volatility of cash flow. So again, you can imagine that there are peak times, that there are trough times, and in a ski market in the summertime, you would expect a lower aggregate demand that is pouring into the market. So we can still do things to really capture what's available, but you would expect that the overall pie has shrunk, where when the powder is fresh, the overall pie grows quite a bit. Finally, let's talk about the arrived investment thesis in each of these. So for single family residential, this couple of pillars and North Star philosophy. So we want to try to be near construction costs, right? We want to try to get into that low basis because the property values can range a lot. Land can be very stretchy in value, but we're going for utility here because we want to really make maximum income on our invested dollars. So try to be near the construction cost for the assets that we're getting into. Again, invest in lower price points. This resonates well with the prior point that we can find better rent to purchase price ratios in that, and thus better yield and better income. Stay close to infrastructure. People have to work. People want convenient services. This is where they live and how they orient their life. So you want to be close to certain infrastructure, certain highways and things of that sort. I've been in neighborhoods in Atlanta where it takes 15 minutes just to drive out of the neighborhood and to get to one of the main roads that'll then take you to the freeway. So those are challenging if you are looking for high rentership. If you're the owner, great, make those types of choices that suit your life. But as a renter, we're looking to have infrastructure nearby, and then we're going to balance cash flow versus appreciation. So what we mean by this is that you can earn income in 2 different ways. You can earn it through rents, and then you can earn it through the appreciation of the asset. And that goes for any income producing property, not just SFR. But when we're talking about the balance between the two, it implies a certain price point. It implies a certain operating type of operations. So we're trying to get anywhere, from, call it 4 to 6% on the cash flow yields, depending on the price points at the assets. And then similarly for appreciation, don't know the future, but for the past 20 years, across the US average, we've observed about 4.5%. Now let's talk about vacation rentals, investing in uniqueness. That's part of our thesis, because you could do it a multitude of different ways. First, you could invest in cookie cutter condos across from Disney and 2-bedroom, 2 baths, and just kind of the Target sheets and Target Disney branded sheets. And what we're looking for is investing in uniqueness, right? What really sticks out? What makes sure that as the pie grows or contracts, that we're still that first slice of pie that gets consumed. And the bigger the better. We just find that the revenue opportunities exist at a little bit of a larger asset because we're capitalizing on groups and being able to spread out the economics of the stay. Be drivable to population centers. This really has to do with the smaller markets that we've chosen to enter into alongside our larger markets. As tourism is an industry that is heavily dependent on the economy. So if we're in any kind of recessionary environment, cash gets tight. So it's not core housing, so it is leisure. And that's one of the first things to get cut out of people's budgets. But there are plenty of people who would have flown to Europe, and instead they'll be driving to the Poconos Mountains. So we want to be drivable to population centers, accessible to tens of millions of people. And again, maximize revenue. Now, this may sound like one of those types of moments, but it's very different in the sense of how we look at what is the objective here. With SFR, we're looking to find those balanced assets that really have a great floor, constant cash flow, and just kind of inches its way with appreciation over time. With vacation rentals, we're investing in an experience, so we want to maximize revenue. In terms of the expense profile, there's a certain amount of expenses that stay kind of fixed. Your utilities can only go up so much. You're paying the same internet bills, et cetera, et cetera. So if we can really drive that top line of revenue, and again, to bring back the pie analogy, if we're always that slice of pie that gets consumed first, that's really our focus. If we maximize revenue, that's how we believe we'll maximize cash flow, which is a bit of a different angle than saying minimize expenses, because again, we're going for 5-star experiences here. So sometimes we try to avoid being penny wise but pound foolish. So that's some insight into our two strategies that we offer right now on Arrived. And now I'm going to turn it over to Jake for some investment returns.
Awesome. Thank you very much, Cameron.
Thank you.
So given all of the differences in the investment strategies that Cameron was walking through, it's understandable that each investment strategy has a different range of potential returns commensurate with the different levels of risk of investing in each individual strategy. So today we're excited to roll out this new matrix, which really helps communicate the potential returns on Arrived. And it looks at returns by looking at the combination of the investment strategy as well as any leverage on the property. These ranges best represent if you had a diversified portfolio of properties within the investment strategy. Any single individual property may wildly outperform or underperform these ranges, but these ranges are indicative of the typical returns of the investment strategy. So taking a step back, we're talking a lot about risk and return. And there's risk and return across a broad spectrum of different potential investments. This chart's meant to have a very simplified illustration of that risk-return trade-off, which really means that if you as an investor want higher returns, you need to be willing to take on higher risk. So take cash that's sitting in your savings account. It's very low risk, but it also is generating very low returns from interest. On the flip side, if you're investing in private equity or venture capital, it's a very high risk investment that could come with potentially great returns. The Arrived single-family residentials and vacation rentals are roughly in the middle here compared to these other investment strategies. It is also meant to show that those vacation rentals have a little bit higher risk compared to the single-family residentials based on all the things that Cameron was talking through about how they're operated and which types of properties they are. Now, here's another way to look at the risks and returns of those two investment strategies. In this chart, that green dot represents the average return, so the average return of a property within each investment strategy. Now, it's a little bit higher for those vacation rentals to show that on average, vacation rentals do have higher returns. But you can also see that that potential range of returns is much wider. So phrased differently, the single-family residentials have a higher floor but a lower ceiling, and the vacation rentals have a lower floor but a higher ceiling. What this is showing is that vacation rentals have more volatility or risk in the performance of individual properties, but that also comes with higher potential returns. That's a bit on the differences between the investment strategies, and the other component of this is leverage. So this chart is very similar to the last one, but instead of looking at investment strategies, we're looking at the impact of adding leverage. So when you add debt to an investment, it adds an additional layer of risk, but it also increases the potential for returns compared to that base risk return of an investment without leverage. So similar to the last slide, as we add leverage going left to right across this chart, that average return increases, but so does that potential range of returns. So what I usually tell people is that leverage will make a good investment really good and a bad investment really bad. And that brings us back to this new matrix of returns, where investors can take a look and see the impact of what that range of returns is by investment strategy, as well as with the combination of with or without leverage. Now, of course, there are differences in the risk return of individual properties within an investment strategy too. But for the most part, a single family residential in Knoxville compared to Denver is going to be similar enough that they're all kind of represented within this range. Again, these returns represent a well-diversified portfolio of each investment strategy, as well as the combination with or without leverage. Ultimately, again, the returns of each individual property will depend on the performance of that property's rental operations, as well as the appreciation in that particular market. And certainly a ton of properties will outperform or underperform this range. But the more investors diversify and buy into a large number of properties, the more likely it is that their overall portfolio returns will end up within these ranges over the investment period. And with that, I'm going to bring on our CEO, Ryan Frazier, to do a little bit of a demo of the new pieces of our property pages that showcase this returns matrix, as well as the new investment calculator.
Awesome. Thank you, Jake. And let me share my screen here. Give me a moment to switch things over. Perfect. All right. Now that we've talked a little bit about the different investment strategies that we have available on Arrive, single family residential and vacation rental, and we talked about some of the risk and returns and how those are different across different asset classes, we want to talk about what we're introducing on our Arrived property details pages, which is a high-level overview of each of the investment strategies alongside the property, and then a historical returns calculator to better model some of these scenarios that we've talked about. So to start, I'm just going to go to our website, click on Browse Properties, and then we've got a couple of new vacation rental properties coming available this week. I'm going to click on the Seafoam here, which is a vacation rental property in Panama City. And you'll notice that there's a lot of information on the property detail page. A lot of this information is important for evaluating any of our individual property investments. But for this conversation, we're really just going to scroll down and pay attention to the investment strategy historical returns section and the investment strategy returns calculator, which are the things that we've updated this week and that we wanted to make available for folks. So to start, you'll notice that the historical returns are now looking at the investment strategy as a whole instead of just this specific property. And as Jake mentioned, the investment strategy returns here, the 5.5% to 12% per year for a unlevered vacation rental, is specific to a basket of well-diversified properties within this investment strategy. We can also see that this is a strategic refinancing candidate, which means that if the interest markets or the market for interest improves, we would seek to add a mortgage to this property and kind of capture the benefits of leveraged returns here as well. And if we do that, then we'd see that the historical rate of return for a vacation rental with leverage added would be more in the 6 to 15% range. When you're looking at vacation rentals and you're comparing that against long-term rentals as well, or our single-family residential properties, you'll see that the range is a little bit wider. And that goes back to the example that really Jake was highlighting, which is that the risk and returns and the potential spread between those things will be different for each investment strategy. So as we scroll down, we see, the historical returns for this investment strategy will come from rental income and appreciation. And then we'll show the current breakdown of rental income potential here. And for this property specifically, it's anticipating a 4.5% rental dividend yield per year. So that's the annualized dividend rate that it'll intend to pay out on an annual basis. Anything above that would then kind of come from property value growth. The other thing to note with these historical kind of ranges of returns for investment strategies is that this is net of all operating costs, closing costs for the property, and the future potential selling costs for selling that property, as well as any arrived fees. So this is all net of ongoing costs and fees to make sure that it kind of well articulates what an investor might expect with a diversified portfolio of these type of properties. Now, if I scroll down and expand the returns calculator, we can get into a bit more detail. And this is really meant for investors to be able to evaluate different scenarios. And we'll kind of go through a few of those hypothetical scenarios to start. So to begin with, you can select an anticipated investment amount. So if you have an amount of money that you are anticipating investing in this specific property or in this investment product strategy, you can select that from a drop down here. But we'll start with $1,000 just to keep things round and simple. First, you'll notice that there's a slider to kind of update different potential dividend yields or annual appreciation. The starting point on the dividend yield is the current dividend yield for the property. And the starting point on annual appreciation is the 20-year US average. And that is an update, is that we've started to look at the national average over a much wider period of time as a starting point. You can kind of easily toggle to some other presets. For example, the 10-year or 20-year historical appreciation specific to the zip code that this property is in. So for example, I'll click the 10-year zip code here, and you can see what impact that might have on the annualized total returns compared to the 20-year US average. And when you think about the annualized total returns here, this is an IRR calculation after any property operating costs, property closing costs, and arrive fees. And so it is capturing the IRR over the hypothetical hold period. And for vacation rentals, it looks at a 10-year basis. And for our single family residential properties, it looks at a 7-year basis. The last thing I'll note is that you have the ability to kind of toggle leverage. So if the property is already financed, it already has a mortgage on the property, then by default, the leverage toggle will be turned on since that property is intended to be operated with leverage. Similarly, if the property does not allow debt, if it's a no debt property and it doesn't anticipate adding financing during the investment period, then this toggle won't be able to be toggled on. But since this is a strategic refinance candidate, initially we're operating the property with no leverage, but in the future, if interest rates improve or become more favorable, then we'll seek to add leverage. And you can see the impact on potential returns if leverage is added during the hold period. And if we scroll down, we can also see the annualized rate of returns and how much dollars you might expect to get back at the end of a hold period for the different levels of historical appreciation. That'd be the 10 and 20-year US average, and then the 10 and 20-year specific to the zip code that this property is in. So that's a quick overview of what we've updated on our property details page. We hope that this does a better job of highlighting the investment strategy as a whole and what type of returns for an investor who's looking to diversify into a specific investment strategy, what they might expect. We also hope that it better kind of articulates the impact of adding leverage to investments, and then also gives investors control to look at different hypothetical scenarios on things like if the dividend yield changes over time, or if the property value in that market appreciates with the historical US average or the historical zip code averages. And so with that, I think we will pause the kind of discussion portion of the webinar, and then we'll look to jump into Q&A. So I'll invite everyone back on the stage with me. I will stop sharing my screen. And yeah, look forward to answering any questions that you all have.
Fantastic. Ryan, thank you so much for walking through the live demo of our new returns calculator. Cameron and Jake also for your prepared remarks. And we have a whole host of folks on the line from all over the place today. So excited to jump into a few questions. I know there was some that aren't particularly related directly to the returns calculator. So excited to jump into those. First and foremost, there was one from Masato. Speaking of Atlanta, I noticed the recent 3 Atlanta properties are still marketed for rental. It seems a bit slower than average. Can you touch on that? Cameron, if you could walk through a little bit of our process and what that looks like for Atlanta in particular.
Yeah, sure thing. I think that's a fair observation. I was taking a look at a property or two this morning, and I think that there's just seasonality involved, and it's kind of a roll, not a roll of the dice, but various properties, they may be great, but they may face a lot of competition. So there's a lot of different permutations of what supply and demand look like. I would say that Atlanta is a very institutional market. There's a lot of aggregated demand there from American Homes for Rent, Invitation Homes. They have well over 3,000 homes there. So Atlanta in particular is a top 10 MSA. So there's a flood of demand that comes in. And then that pie that I was referring to earlier in my presentation, it can shrink and expand pretty quickly in those types of markets, especially if you get a little bit further out. So I think that this is not uncommon, but I can tell you some of the things that we do. We look at rental rates probably every 2 weeks for adjustments during hotter times. And what I mean by that is when there's higher demands, you have higher quality signals that the market tells you. So you would expect a lot of people to go to the market because they're shopping. So if they are, and you see nobody's checking into your home, first you make sure that there's no operational issues. And if there's not, then you can start evaluating the quality of that pricing signal, because that number, that rent that you advertise out there, that has so much value in it. But you have to make sure that certain things are checked off first so you can ensure a high quality signal. So once all of those things are done, when we are going over weekly evaluations with our property managers, then our team is also looking at pricing, because during the management process, even though we have a property manager, we're actually driving the decisions when it comes to the investment thesis, rent levels, and what we choose to expense and how we improve. So on those decisions, during a period like May, June, July, where there is a high quality signal, we can iterate on price quicker, and I would expect to see that. Whereas you contrast that and you go to winter time, again, if you try to find somebody who's leasing a property between Thanksgiving and Christmas, just because you don't see much activity doesn't tell you I need to drop the price. There's not enough market activity to necessarily validate that. So it's a lower quality signal in that shorter time frame. So anyway, some of the analysis that we do go through, but I can assure that as a portfolio, we comb over these, look for pricing adjustments. And if there are none, then, really dig down into quality checks, look through the feedback. A lot of the showing systems, which is auto checking in, they have really good feedback mechanisms now. So to the extent that there is feedback available, we also operate on that.
Fantastic. Thanks so much for walking through it. If any further questions around that topic, definitely let us know in the chat. I'm seeing some great feedback today. As you know, we are building for and by each and every investor, whether you're currently on the platform or thinking about it. And Ryan, I did receive a DM earlier on about the returns calculator. Obviously, this is new and revamped and refreshed. At what point does the team decide to make changes to help educate investors?
Yeah, I think in general, we really look to any of the feedback that we get from investors. So if we're hearing questions come up on an ongoing basis from different investors, then we might look into that and, how can we make that more clear? As folks can imagine, this is certainly a topic that we get a lot of questions about, and that we've been working hard to figure out, what's a clear way to articulate the different types of returns from an investment strategy perspective, and what makes up those returns in terms of how we're getting, the rental income and the property value growth over time, and just how to think about that. So we hope that this gives a little bit more visibility into that as an investment strategy level first, and then some flexibility for investors to look at different scenarios from there.
Fantastic. Thanks so much, Ryan. And it really is the best place to gather feedback in our webinars. We have a subreddit, social, live chat on our platform, email. I know our carrier pigeons are out and about as well. So feel free to send it our way. We absolutely love building for and by everybody that we get to engage with every single day. So I have Benjamin, great feedback on asking if there's any Arrived merch coming in the future. Definitely. I saw you had asked about coffee mugs. I know Jake's flexing his right now. So let us know what else you'd love to see. We'd love to hear from you. Cruising through the questions here, one moment. I believe there was one. Obviously, we know there's a myriad of different platforms and ways to invest, whether it's ones that are like Arrived or different traditional REITs, so on and so forth. So this will probably be a little bit of a combo between Ryan and Cameron. Ryan, I'll kick it to you first. What would you say would be Arrived's biggest differentiator overall?
Yeah, I mean, I think initially we've really tried to make it as easy as possible for folks to invest in single family rental properties and vacation rentals. And so, I think one of the big focus is being able to let people invest in the equity and residential properties. And as Cameron articulated, the investment operating strategy, doing that well and identifying these properties across the country in all the markets that we're in and operating them effectively so that we can drive rental income for investors can be challenging. And so we've spent a lot of time to try to develop that as a skill set within Arrived and leverage our team's experience to do that. So I'd say that's really a big area that we've focused on. And Cameron, I don't know if there's anything else that you'd add.
Yeah, I think 2 points as far as the difference between what we see in competition versus what's available here. First is the individual property level. There's a lot of great companies out there, say like Fundrise. They're really great operators, have great real estate offerings, but you kind of don't know what's inside of those packages and those funds, which, again, I don't doubt how high quality that organization is, but you don't know, right? You don't really have access to it. Whereas Arrived, we really attempted to solve from the very beginning the atomic unit of the property, everything about it, from images to having its own individual story. You get to see them and you get to invest $100 at a time in it. That small unit, I think, is something that really differentiates us, where some of the other platforms, you either kind of don't know what you're buying or you have to buy a whole house, right? And that goes to the original value proposition. It's like you don't have the capital, time, or expertise to invest in one, much less 10 or 100. And and I would say the other part that I think really differentiates us is how closely it mirrors both the economics and the experience of owning it actively, but in a passive way. So you can own 100 across 20 different states, but you get one consolidated tax statement. You get all your distributions quarterly. You get everything kind of rolled up nicely in one package. So it's funny. There's a dichotomy of a very small atomic unit of what we've kind of harnessed at giving you visibility into the individual property, $100 at a time. But then on a larger portfolio scale, you can construct it in a really unique way across 20 states and 100 properties that, you may, on the flip side, other products, you don't have visibility into even one asset, much less incrementally building the 100 that you own. So I would say that it's an interesting dichotomy, but it's what I find unique about our company is kind of the small unit of ownership, but the big portfolio that you can create.
I'll add one more. Cam's talking about the understandability factor of knowing what you're actually investing in. With Arrive, you also have a customizability component. So with a lot of the larger REITs or different funds you can invest in, it's kind of a take it or leave it proposition. You either invest in the properties they have or you don't. It's very black and white. And with Arrived, we kind of give investors that choice and ability to pick and choose what interests you. So some folks may be more interested in single family versus vacation rentals. Some people tend to be more interested in, East Coast markets compared to West Coast markets. We really want that kind of power and control to be in investors' hands so that you, one, feel comfortable knowing what you're investing in, and two, can kind of start to build a real estate portfolio that's customized to your specific, kind of needs and desires as an investor.
Fantastic. And Mevelyn had some very kind remarks about Cameron. So Cameron, thanks for walking through it. And I realized Mevelyn asked specifically about timeshares. Cameron, like Arrived compared to owning a timeshare. What are your thoughts on that piece?
Oh yeah, that is an interesting question, and I'll answer it in the context of a vacation rental, because that might be a clearer, something that's seemingly like, oh, a vacation rental kind of sounds like a timeshare, but I'll hopefully be able to articulate the difference. So one, I'm not an expert on timeshares, but to my knowledge, a timeshare is a very different instrument than ownership of equity. My understanding is that a timeshare is basically you have a right to usage and possession delineated by a certain bank of time, and that's up for negotiation on the marketplace. You want to trade times with people, you want to sell and kind of monetize the value of yours to someone else for that usage, but it's centric to a usage right of what a timeshare, and usually embedded that is kind of a really expensive management agreement that you have to pay whether you're utilizing it or not. So that's kind of where what I understand that part of timeshares to be. Whereas with an Arrive vacation rental, to kind of go over really quickly what you own when you buy an Arrived share, we take the property and the structure that exists in the real world, we create a company, and then that company owns the real estate. Then on Arrived, we qualify that company to be able to sell its equity online through an SEC qualified offering. And when you buy that share of it, you're buying the ownership stake of that company, and that company holds that property. Okay, so that is what you're owning. So you're owning equity in a company, and that company fully owns the property. So that is basically mirroring effectively property ownership. It is property ownership of the company that holds the property. Whereas with a timeshare, you're owning usage rights, which is very different. Now, vacation rental, the way that we have structured it on Arrived is that you're entitled to the economics of it. So there's not a usage component. Not to say that you can't go stay there, but you do owe your fellow 2,000 investors the accommodation fare and cleaning fees for that night. So that's how it would work, as if then, the rent and all those payments go to the LLC, and then it gets distributed out to all of the investors, you included. So that's the difference between the timeshares of what you own versus equity in real estate, but done via the vehicle of a company.
Fantastic. I was trying to move out of mute really fast. I did see one that was actually a DM in here. And Ryan, I'm going to kick this one over to you. I know you had mentioned the range on the calculator represents the return of a well-diversified portfolio. Can you elaborate a little bit on what that means? I know we have some folks on the line that are well-versed with Arrived, and then we also have some newcomers.
Sure. Yeah, really in simple terms, what we mean by, well-diversified portfolio is adding multiple properties. So instead of putting all of your eggs into one basket, all of your money into one Arrived property, spreading that across multiple properties, and that really provides that diversification. In terms of what is a well-diversified portfolio, the best way to think about it is, the larger the number of properties gets, probably the narrower the band of potential returns you might expect for your portfolio as a whole. So there's no kind of silver bullet in terms of this is the exact number of properties to strive for. But I think the right way to think about it is the larger your sample size grows, the narrower your band of potential outcomes might be, and it'll start to look a lot more like the average for that investment strategy. And similarly, as you diversify over time as well. So if you're investing in, properties on a quarterly or on a monthly basis and kind of dollar cost averaging into these investment strategies, it's another great way to add to that well diversification or well diversified, definition. But that's really how we think about it.
Fantastic. Appreciate you walking through it, Ryan. I always recommend looking at the different markets that we have. I believe we're close to 40 different markets, over 250 properties on our platform spread across 2 different asset classes. So a lot to take a look at. We're typically releasing new properties every 1 to 2 weeks. They do have to be qualified by the Securities and Exchange Commission before they are available, a process that we're very proud of. So more to come. We have 3 available and coming soon, 1 to invest in now. I saw some feedback in here from Benjamin, who just left some incredibly kind feedback in the chat. Ryan, I'd love to hear your thoughts on this, as we just talked about different players in the space. Could you do a segment someday on the pros of your platform compared to other commonly known platforms in real estate crowdfunding space? For example, Fundrise, which Cameron, I know you referenced. I definitely prefer your platform, but curious on Arrive's view of their competitors.
Sure. Yeah. I mean, I think that we chatted a bit about this previously and some of the differences for Arrived and why investors might choose Arrived over others. There's a lot of great platforms out there. I think, for us, really some of the pillars that we point to is one, the transparency and the control. So the ability to come and pick and choose which properties you're investing in, and then be able to build a portfolio around that is, a big part of what we've tried to do at Arrived. And then underneath that, really focusing on equity investments into single family residential and vacation rental properties, which we felt like, people really wanted to own. When you think about other platforms out there, there had been a lot of, platforms that brought commercial real estate to market, and others that allowed you to invest in real estate debt. And, under certain circumstances, those can be great investments as well. We think, under the right timing considerations, perhaps one day Arrived will make some of those investments available as well. But for now, we've really been excited just about, the kind of track record and pace of single family homes. And I think especially the interest and demand from investors to be able to participate in those type of offerings. And so that's really what we've focused on so far.
Fantastic.
I'll throw a few more thoughts on that for just more competitor talk. And not even just competitor, but even what are your options out there for investing in real estate? So there are public REITs out there, and a REIT stands for a real estate investment trust. So the larger landlords, and when I say corporate landlords, I don't mean that in a negative way. Actually, they're very well-run professional businesses. But usually the way that you invest through them would get on your brokerage account through Robinhood or E-Trade, and then you go buy stocks, say AMH for my old company that I worked at. And there's a really interesting study that we did as far as we tracked our share values, and then we tracked the values of real estate investment trusts in the single family residential industry over the same time. And we were in the plus double digit, and there was a negative return on the public REITs. And we're operating the same model. And I know that they're extremely good operators. They're my former coworkers, and they run a really good shop. So no way they should have been, down. The business was doing really well during that time. It was down, but it was just public market exposure. So what you're sometimes inadvertently investing in when you think you're getting real estate exposures, you're getting even more public market and kind of interest rate and liquidity exposure of those trillions of dollars that slosh around in the public markets. And that's not really the behavior of real estate, because if you checked on real estate prices over the last couple of years, then they've done really well, right? So that's one of the big differences, I think, for a similar operation with the exact same asset class. How can you have such a divergent return performance over a couple 2 years? And it really has to do with, well, you're really buying public market exposure when you invest in public securities. And Arrived is private real estate, but done through SEC qualified securities for non-accredited investors, which I think is also a good segue into one of the other critical differences. You can see services out there that may have some value proposition, get this ownership stake, or we do this kind of operating model. But if you look in the print of who it's available to, you'll see that it is very often what are called accredited investors. It's only available to them. So they're basically a class of investors who meet either income or asset requirements. And it's a much smaller percentage. I'm talking single digit percentage of people that would qualify. So just be cognizant of that we are a Reg A SEC qualified security. So any adult kind of asterisk, there's a couple things in there, but more or less it's open to the public at large, right? And a lot of investment opportunities that are out there that do sound good, that sound like they're a great way to invest in real estate, that makes sense. It may all be kosher, but it's only available to accredited investors. So again, a couple differences there on what to look for, because we can get kind of tied up in the details of like returns and this number and that number. But is it even available to use one of the very fundamental questions that we face in the investment space?
Fantastic. Thanks so much for the added insight, Cameron. I will say too, to that point, obviously I've mentioned this before, a lot of different ways to invest, like platforms, different platforms. We always recommend doing the due diligence. We try to make our content as easy and as accessible as possible. We always recommend taking a look at the offering circulars and any platform that you're choosing to invest in, just so you have all the details as well. So we make those accessible on every single property page under the documents section. Feel free to dive in, ask any questions you might have. And absolutely, for anybody that has registered, you will receive a recording after this. I saw one in here from Ashish. What can you say about giving us confidence in investing in Arrive.com? Definitely the costs are higher than investing by ourselves, plus risks involved with your operations are higher. We are really not in control over the selection of the property as you invest in all over the country. For example, one of our properties seems to be near a highway and may have a lot of noise and hence not that attractive. Cameron, I think this might be great to kick to you first in terms of like our acquisition process. And then Ryan, if you have any added insight on Arrived and, confidence building as well.
Yeah, sure thing. So let me kind of go through the question in order of how I heard it. I think the first reference had to do with costs. So let me quickly go through our fee structure at a high level so you can understand what the fees are. And then you can kind of evaluate, well, in the context of that, what are you then getting in exchange for those fees? So we have two classes of fees. One is called the sourcing fee. The other is assets under management. So first, the sourcing fee really has everything to do with capturing an opportunity that exists in the market. It's a piece of real estate that may be publicly listed for sale or may even not be publicly listed. And that's some of what we also offer is access to channels that may not be public. But then we acquire the asset. We do due diligence that involves in really looking into the title, the HOA, all the rules, make sure that we can operate as a rental. And then we also do a lot of inspections on the property, around 2 to 3 on average. That includes termites and sewer inspections in addition to your normal one. So then we go through this process and then we're qualifying with SEC. We're putting into this offering document and qualify every property. So all that right there is known as sourcing, right? And for long-term rentals, it's 3.5% of the purchase price. So on a $100,000 property, it would be $3,500 for the sourcing fee. Okay, so that's just like a basic rundown of what it does. But basically, it's the acquiring, it's creating a security, making the opportunity available to the market, right? That's what sourcing is. And then assets under management is, well, you're going to hold these assets for 5 to 7 years, 5 to 15 years. So in the process, we're maximizing the cash flow of it, and we're also doing all of the entity and tax and financial administration necessary to have a crowdfunded investment, get your dividend payments, file taxes, all those sorts of things. In addition to making sure that we're getting the max cash flow from a investment strategy point of view on behalf of the investors. So those two classes of fees, and I just want to kind of lay that out there because then to the point about, hey, wouldn't it be cheaper to do it by myself? Absolutely. And look, I come from an entrepreneurial real estate family, so we're in the business of doing it by ourselves. So I definitely understand that, that an individual savvy entrepreneur is the best investor out there. Hands down. And I don't have any question about that. It's a lot of work though. And growing up in that type of family who is investing in real estate, that's your first job, but your second job is actually trying to generate cash flow from it. So that includes rental operations, that includes random entrepreneurial things that try to just generate cash flow to pay for taxes, for holding things and holding costs. So it's a very difficult business to be in. And once you own one house and maybe 2, 3, getting that scale, it's very, very difficult, very active. So, to the extent that there's a difference in costs, I think it's fair, right? But as far as the value proposition goes of what can you get, some people who are pretty experienced in real estate investing, they say to us, why should I invest in Arrive? And, they say, I have my own real estate portfolio in the place that I live. And that's great. What about outside of it? Are there places you want to invest and you just feel like you haven't had the time or capacity to make it out to the market and make the decision? So that's a little bit of context of like, hey, is it worth it? Think about it from making a very active endeavor to passive. And that's how I would contextualize kind of what the fee is. So I think that was the first part about costs. And then there was a second part about operational risks being higher. I think that, yeah, certainly it's, as I was saying, it's challenging to operate across 40 different markets, right? With all these different management entities. So I would say that any one home, whether you're doing it entrepreneurially or we're professionally managing it, it can be a risky venture. So to a lot of the points, diversifying yourself, you really do get benefits pretty quickly with 2 to 3 and then 5 and then 10. And it's looking very diversified on not only the top down of which markets you select, but also on the operations and which tenants you end up leasing properties to or which guests you get in your vacation rental. So I think that risk is inherent in operations, but having a portfolio helps de-risk any individual risky operation or endeavor. And agreed, you're not in control of the selection of the property management, but you are in control of which properties that you choose to invest in. And certainly invest in whatever helps you sleep at night, whatever operating plan or part of the country or asset that is not by a freeway that you feel good about. Encourage you to invest in those. So anyway, hope I addressed all the main components of your question.
Absolutely. I think you got it all, Ryan, unless you had color to add. Perfect. All right, we'll keep trucking here. I know we're getting close to the top of the hour. Jake, you've been crushing it in chat, but I want to get you into the mix here. There was one from Serge. Hi, y'all. Can you provide an update on property valuation? Can you talk a bit about the process? Some of my properties are over 6 months old, but still awaiting to be evaluated. I understand your website says it can take up to 6 months or more, but I'm curious as to why this is not as an easy process as running a batch job or clicking on a tool to update the property's valuation. Fantastic question, Serge. I know Jake knows all the ins and outs.
Yeah, it takes a little bit of effort because Cameron and I are largely the batch job that runs through those property valuations. The way it works is we go through and we do a valuation of what each individual property is worth today. We kind of estimate what we think we could sell it at if we were to go to the market immediately. And we combine that with all of the other assets and liabilities that LLC owns. And that helps us kind of spit out what the current equity is in each individual property for investors. So we start doing this about 6 months after the property launches. And it's, if your properties sounds like probably just missed the cutoff for our end of Q1 update. So they're probably about 6, 7, 8 months old, and they'll get their first valuation when we do our next batch at the end of Q2. We are working on getting those first valuation dates posted in your portfolio. So you'll actually be able to see when your properties are going to get their first valuation or their next valuation. But that's a little bit on how that process works. Well, we're definitely working on some improvements to speed things up. But in the meantime, we don't rely on algorithms to, price our individual shares or to tell us which properties to buy. A lot of what we do is technology and, kind of combined with that human touch and that human expertise. So it isn't as easy as just going to Zillow and saying, hey, here's what the Zestimate is for this particular property. There's a little bit more that goes into it to make sure that we can get accurate data and get investors kind of the best estimation of what their shares are worth.
Fantastic. There was an LOL in the chat from Serge about being the human batch job. So definitely appreciate you and Cameron making that accessible for all folks. And as our Senior Director of Product, Rex, mentioned in the chat, we're actively working on it. Looks like I think we have a couple of the engineers working on the first valuation date watching this webinar live. So great place to leave feedback. Keep it coming our way. It looks like we have 2 more questions before we shut our virtual doors for the day. One in here from Larry. Is Tulsa listed above OKC? Cameron, I'll kick this one over to you.
Yeah, I was tracking this one in conversation, and I think the essence of the question was, hey, Tulsa, we have 5 properties that we've gone under contract and acquired, and then in Oklahoma City, there's none, despite Oklahoma City being a much larger metropolitan area. So I think that where we can go with this question, maybe first let me address Oklahoma, and then I'll address market selection more generally. So Tulsa, we like the area because, quite honestly, we like Northwest Arkansas a lot. And kind of by proxy, Tulsa is one of those smaller areas that may have better growth opportunities and just where more of the appreciation and kind of sentiment tends to be trending. So size is certainly a big factor in determining where you invest, because you need a large enough place to have a little bit more stability. It's not like large things disappear overnight, but we're also investing for the future, right? We're placing bets across the roulette board to say where we're going to be hitting it based on where we can observe a lot of forward-looking population trends, growth. Where's the economy growing? What kind of policies are people looking for? That determines a lot of macro migration trends and demography and demographics. So a little bit on Oklahoma, and I would say more generally, it is, just to speak a little bit more about that future forecasting exercise. As the saying goes, past performance is not indicative of future results. So if we look to a place, that has grown the most in the last 20 years, we might end up in a place that has already topped or seen its growth. So we just have to be a little bit careful. Huntsville, Alabama is a place that comes to mind where it's not the largest place. For Alabama, it's fairly large, but in the grand scheme of all the places you could invest, it's modest. It's around 500,000 people, but its growth rate's incredible and its forward-looking trajectory looks amazing. So while we look at some of the calculator returns that we have up there as far as past data that we can observe, because we're not in the business of forecasting the exact future, but past data is very instructive and useful. So anyway, there's not a simple answer, right, to how we select markets, but we have to balance what we know historically versus what we can tell going forward. And for now, we like Tulsa a little bit more than Oklahoma City, but it's also often a question of just opportunities that present themselves. Not to say that we won't end up in Tulsa eventually, or I'm sorry, Oklahoma City.
Fantastic. Appreciate it, Cameron. I'm seeing some notes in the chat about our mobile app. So it's currently in beta. If you have an iPhone and would like to be added to the beta, feel free to email support@arrive.com and we will get that set up for you. We're hoping for the Android app to follow later. So more details to come in that space. But I know Craig and a few others were very interested. We'd love to get you in there. I know I'm buying shares on the mobile app, which is very exciting, as well as the rest of the team on the call today. A couple more questions that we have in here. I've been following Arrive for a few weeks. I've noticed most of the new listing are vacation rentals. Can we expect more traditional single family rentals in the future? Cameron.
Oh, yes. So we're definitely got a lot of long-term rentals and single family SFR in the pipeline. Right now, we're just juggling some kind of SEC qualification issues. So once we get through those, there's a nice log of single family rentals coming and new markets, I might add. So keep your eye out for that.
Fantastic. Another one in here from Venkat. I see a lot of properties and returns page at least 30% of appreciation. Just curious why you plan to see those appreciated properties. Can you give us some details about selling the property which appreciated a lot?
Yeah, sure. We can talk about holding period and when do we look to sell the property. So for SFR, we are targeting 5 to 7 years. And then for vacation rentals, it's 5 to 15 years. So first, what do they have in common? You hold them for 5 years. Single family homes, residential, they've historically appreciated pretty steadily with population growth and GDP growth. But, not everything is always a linear process. So we want to give enough time to make sure that there is an adequate amount of appreciation, which is a big fundamental component of the investment thesis. And then there's disposition costs too. When you have to sell in the real world, there's people that help with the transaction that they have to make a living too, and there are naturally selling costs. So we account for that in the calculator as well when you're looking at return profiles. And 5 years is what I would say is not when we look to sell, but it's that we will sell, but it's more like, is the opportunity right? First, at a very high level, is this the right macro environment? And then second, tactically, do we want to sell this house right now? Is it favorable now? Or maybe it is macro, we determine yes, but when the lease ends 9 months from now, we'll send a notice of non-renewal and then we'll sell them. So we'll start establishing the plan and say, hey, actually, we want to hold it for another 2 years for sure, because right now is not the right macro environment to be selling the property. So the clock starts ticking on how we evaluate the exit plan, but there is no formal requirement to have to sell it within even the 7 years or the 15 years. So now let's talk a little bit about the upper boundary, 15 years on vacation rentals, because that's the more interesting one of, well, why the longer time horizon? And it really has to do with investing in FF&E. So it can be a substantial portion of the investment to furnish a house and invest in things that are more experiential. So that personal property, unfortunately, does not appreciate like structure and land. So the best usage of out of it is to generate income. And if we can generate good income off of that personal property for a long time, you're going to get the best use out of that investment, because it's not going to have much salvage value. You won't be able to sell it on Craigslist, especially if you get 15 years of operation out of it. But if you did, it definitely served its mission well. And we definitely extracted the income out of that couch. So that's why it can be longer for vacation rentals. And as far as the return numbers, so there's a couple of different options that you have, right? You can look at the 10 and 20-year historical for the US or the zip code. And maybe the 30% figures that you may be referring to is gross appreciation. So total appreciation over, say, 5 years, 30%, 6% a year. There's definitely homes that we have out there that whose zip code information is reflective of that. And there's also, the second component, dividend income, which is separate from the appreciation. So a couple of things in there. I want to make sure I addressed everything as part of the that was in the question, but timelines and ballpark numbers of what you might expect. That 30% sounds more like a gross number to me, and of total, as opposed to an annual number like the IRR calculator would show.
Fantastic. Thanks so much, Cameron. A ton of great feedback I'm seeing in the chat. I know there was remarks about making longer videos on each of our property pages. I know they're short right now, and you typically see Cameron or Quao on there. So we'll definitely share this feedback with our team about locality and exactly why we choose those markets. So great feedback. I know there was some around account statements, monthly dividends, so on and so forth. So definitely appreciate the feedback today. We are building for and by all of you. So definitely appreciate it. Before we close our virtual doors for the day, Ryan and Cameron and Jake, any closing remarks? Ryan, I'll kick over to you first.
I'll just say thank you, everyone, for joining today. Thank you, Korin, for leading the charge.
Well, we might have to go to Cameron because I think Ryan might be frozen.
Yeah, he was in that position for a while. I thought he was just reading something for a bit, but I think the technical errors, but it's all right. Well, thank you all for being such an engaged audience. Definitely appreciate all of the great questions. These are always great sessions, no matter the size of the crowd. So definitely appreciate all of you here, and hope you have a great week.
Thanks everybody for joining. The whole team is really excited to be rolling out a lot of these new features. So please let us know what you think. Don't be a stranger. You can always reach us at support@arrive.com. Team is excited to see what you guys all think of everything.
All right.
Ryan, good timing. Oop, I think you're on mute.
How about now?
You're good now. Yes.
All right. Thanks, everyone. Yeah. Thank you again for joining. Korin, thanks for leading the charge today and getting us all together. And yeah, hope everyone reaches out with questions, with feedback, and we'll keep working on making Arrive better and better for everyone here. But thanks again for joining us today.
Fantastic. Ryan, Cameron, Jake, thank you so much for prepared remarks and answering all the questions. For the folks on the line, thank you for spending over an hour with us today. We so appreciate having an engaged crew that asks great questions and also gives us fantastic feedback. So more to come. Let us know what you think about the returns revamp. For the folks that were interested in the beta, I sent you emails, so you should see that in your inbox. They're on the way. Otherwise, I hope you have a great rest of your day, and we'll catch you all at the next webinar.
Thanks, everybody.